This is Adrian Helfert with Westwood for your first quarter 2019 update. Reviewing the last quarter really requires looking at the last two quarters. In the fourth quarter of last year, a market sell-off began, and the recipe was roughly 2 parts monetary policy tightening, 1 part trade policy concerns, and 1 part lackluster economic growth. That was a recipe for one of the worst sell-offs in the last 50 years. On Christmas Eve, the bounce started and continued through the entirety of the first quarter with one of the best quarters for equity markets in the last 20 years. In fact, it was a great start for all asset classes. Interest rates were down, equity markets were higher, corporate bond yield spreads improved, even commodity prices were higher. So what's going on here? Global central banks and monetary policy have been far and away the biggest driver of market movements. At the end of last year, the expected and subsequent hike by the Federal Reserve brought a strong negative reaction that the Fed would go too far. In the first quarter, global central banks responded to the market downturn and global growth downgrades with unexpectedly dovish statements. The U.S. Central Bank, in effect, told us it would support investors when support was needed, kind of like the Greenspan put of the old days. In the first quarter, interest rates were down across the curve as both growth and earning expectations were moved lower, and central banks responded by showing the supportive card. Only recently have we seen what is more of a healthy market move come through, interest rates moving higher alongside equity markets also moving higher. In effect, this is what we in the Fed hope for, the implication that economic growth is being kickstarted by supportive policy. This recent move is in line with our outlook for moderating but still firmly positive GDP growth, modest inflation, and lower but positive earnings growth. China is another focus given the trade discussions and the fact that they are the largest contributor to world growth. In the fourth quarter, they also indicated a more restrictive financial condition policy, and that has changed as they are now the best performing global equity market in the first quarter of 2019. Importantly, for domestic U.S. markets, progress continues to be made almost daily in the headlines with China regarding removing and reducing the friction on trade between the two countries. Some important indicators we are watching are inflation trends, especially those coming from earnings reports. We are seeing some wage inflation, though maybe not as strong as employment numbers would predict. Core goods inflation is still disappointingly low and a reason for the central bank to remain in low policy mode. Just recently, the Duke CFO survey indicated more positivity about purchasing trends and hopefully increasing capital expenditures as well. This is a key element for us to see improved growth and market performance in the second half of the year as we expect. Leading indicators and the yield curve are giving us a signal the market cycle is nearer the end and the prospect of a recession is increasing, but we don't see that as high this year. Slow and grow is the name of the game this year. Global central banks will be slow, and without a material catalyst in trade troubles, political upheaval, etc., we look for that to transmit to economic growth. The market has priced a considerable amount of this in already, but there's room for improvement. Selection and security rotation will be key, and we continue to find underappreciated security valuations for this point of the cycle, and within sectors, a rotation to value and higher yielding securities should materialize closer to cycle end. Thanks for listening today, and we look forward to speaking with you soon.